What's going on, YouTube? It's your boy Charles Enoch. You already know we back with another Invest in Myself episode. So run the intro. So today we'll be talking about how to pay off your loan using a line of credit. But before we get started, make sure hit that like and subscribe button for me. My goal is to reach 10,000 subscribers before the end of this year. So I appreciate anybody that takes the time to do so. So the first thing we want to know when getting a loan is that the interest is amortized. So depending on the number of payments, you're going to pay a set amount for that particular month. So for example, let's say you have a 30-year fixed rate mortgage that has 360 payments and the total mortgage is $300,000 and your monthly payment is $1,000 per month. And based on that amortization schedule, let's say 400 goes to principal and 600 is interest. So no matter how much extra you put on that first payment, you are going to pay $600 of interest. You can pay the loan off in full the first month and you're still going to pay $600 in interest. Now with a line of credit, it's calculated by simple interest. So let's say you have a $300,000 line of credit and you withdraw all $300,000 of it. The interest will be calculated daily based on how much you owe on that particular day and not calculated for the month. So while I withdrew $300,000 and if I pay that back in 2 days, I'm only paying 2 days worth of interest. So what we're doing in this strategy is using our line of credit to pay off the loan to convert the amortized interest into simple interest and pay the line of credit off. So once we do that, we'll be using the velocity banking method of using our income and stuffing it into our line of credit to reduce the daily interest and then slowly taking out whatever we need for our expenses. Now, you do have to have a positive cash flow because whatever's left over at the end of the month will stay on the line of credit and pay that down. So with this method, the key thing is you have to have consistent positive cash flow. So I know this may sound complicated, but you already know I have a whiteboard with a scenario and we'll break this thing down. Let's get to it. All right, so we're on the whiteboard. Let's take a look at the scenario here. So we have payoff Peyton. Her income is going to be $5,000 per month. Expenses are going to be $4,500, which leaves a cash flow of $500. Now, payoff Peyton has a loan for $5,000. And the minimum payment per month for that loan, we're going to say $150. Interest is going to be $80 and principal is going to be $70 that $150 applies to. Now, payoff Peyton has a line of credit of $10,000. So we'll go to the other side of the board and we'll see how she'll use velocity banking to pretty much pay off that loan. All right, so we're on the other side of the board. Let's take a look at the scenario. So we're in the month of January. So the first thing that we're going to do is we're going to use our line of credit. Remember, we have $10,000 on it. We're going to take out $5,080 and put it towards the loan of that $5,000. Now, the reason why we have $5,080 is because the interest, remember, interest is going to be amortized for that loan. We have to pay $80 no matter what. If we pay the loan off in full, they're going to charge you that interest for the month. So that's why we're pulling out the $5,080. This is going to free up cash flow of $150 and take our expenses down $150. Because remember, the minimum payment per month is $150. So we freed up some cash flow. Now the next step is we're going to use our income, however we get it, weekly, bi-weekly, monthly. Whenever you get your income, you're going to throw it into that line of credit. Now, if we throw $5,000 in there, our line of credit is going to jump back up to $9,920. Now, the third step, we have no income left because we put it all into our line of credit. Now, how are we going to pay our expenses of $4,350? Easy. We're going to use our line of credit to pay our expenses. So the end balance of our line of credit is $5,570 for the month of January. So if we look, we have that balance and then the interest that we paid We paid the loan off, but we still have to pay that $80 of interest. All right, so we're in the month of February. So the first thing we're going to look at is how much we have on our line of credit at the end of January. So remember, at the end of January, we have 5,570. So the first thing we're going to do, step one is already done because we paid off the loan. So step one, we no longer have. We're always going to go to this next step here. So we're going to use $4,430 of our income and pretty much put that onto the line of credit, pay it off in full to make it equal that $10,000 again. Now, the next step, our leftover income, we're going to use that to pay down some of our expenses here. So when we do the math, we have $3,780 left on expenses. We already know our next step, we're going to use our line of credit, which is paid in full, and use $3,780 of that so we can pay off our expenses. So we see that at the end of the month, our line of credit, $6,220, and we paid zero interest on the loan because the loan is paid off. All right, so we're in the month of March. So the first thing we're going to do, we're going to pay off our line of credit here. So we're going to use $3,780. Remember that in the month of February, our line of credit balance was $6,220. So when we put that in there, it's going to put that back up to $10,000. So we paid our line of credit off. So our next step is we're going to use our remainder income, $1,220, and we're going to put that onto our expenses to pay some of our expenses off. So we see that we have a remainder balance of $3,130. Now we're going to use our line of credit. Remember, we paid that off in full to pay the rest of our expenses. So we're left with a line of credit remaining of $6,870. So if we see for the month of March, we have $6,870 remaining on our line of credit, and our interest we paid was zero because we paid the loan off already. All right, so we're in the month of April. So the first thing we're going to do, we're going to use our income, $3,130 of it, to pay our line of credit off, pay it back up to that $10,000. And then we're going to use the remainder of our $5,000, which would be $1,870, apply that towards our expenses to cut it down to $2,480. We already know we'll use our line of credit that we just paid off and has that remaining available credit of $10,000. We'll use some of that to pay off the rest of our expenses. We see that we have a remaining available line of credit of $7,520 at the end of April. All right, so we're in the month of May. So we're going to use $2,480 of our income. We're going to pay off that line of credit, pay it back up to that $10,000. So it reduces that interest so we don't have to pay interest anymore, right? Our income, the remainder will be $2,520. We'll apply that towards majority of our expenses, leaving it at $1,830 that we have left over to pay. We already know, let's use our line of credit that we just paid off and apply that towards the rest of our expenses. We have a remainder available balance of $8,170 in our line of credit. All right, so we're in the month of June. So the first thing that we're going to do, we're going to focus on our line of credit. We're going to use $1,830, apply that towards the line of credit, pay it off in full, right? Then we're going to use the remainder of our income, that $3,170, apply it towards our expenses to pay most of them off. We'll have a remainder balance of $1,180. We're going to then use our line of credit to pay the remainder of our expenses. We see that we have $8,820 of available on our line of credit. Now, I didn't have enough space on the board, but as you can see, our cash flow, it started off at $500. Once we use our line of credit to pay down the loan, then we increased our cash flow because the monthly payment was $150. So we increased it by $150. So as you can tell in our line of credit, $650 keeps on remaining in our line of credit. So if we follow that trend, in about 2 more months, our line of credit will be back up to that $10,000, and then it will be fully, completely paid off. So again, we're using the line of credit to pay off the loan, to free up cash flow, and then pay off our line of credit a lot quicker. What this does is the loan is amortized. So every month it has a set amount of interest, no matter if you paid it off on day 1 or day 30. With the line of credit, the faster you pay it off, because it calculates it daily instead of giving you an amortized monthly interest. So hopefully this makes sense. Please leave a comment down below. Don't forget to like and subscribe. Like always, you guys have a beautiful day. Peace out.